With me today is John Jacobi. He is the non-executive director at Comstock Resources, and he'll be speaking at Hart Energy's Doug Haynesville conference in Shreveport in October. We're looking forward to that, being able to get together. John, thank you for your time, and let's talk about natural gas and the opportunity as it relates to shut-in. We know it's a difficult time. Many companies are working to navigate, but what do you see as opportunities there?
Jessica, I've always been a proponent of natural gas. I've talked about it a lot. I do think it's the future of our industry. Oil definitely has its place, and it by no means is going away. And we need that not only for national security, but worldwide security. But I have always thought in our future and in the wave of the environmental situations we're in around the world that gas is going to be the energy of choice at some point in time. So I think there's an opportunity to look at it as a long-term commodity that we should own and we should promote, because I think the world is looking for cleaner, better ways to provide energy for their population. So I think there's a place for it. I think it will over time be the commodity of choice, and we plan to have it in our portfolio starting our new company.
And with that thought, nat gas is poised right now for a great winter to 2020 into 2021. Estimates are supply will fall to 84 BCF a day, but February demand is usually higher than that. What's your outlook there?
I'm a little mixed on what a projector of a commodity thinks that the price is going to be. We're having a fairly interesting spring. Not only is it cool in the Northeast, but it's also cool where I sit today in East Texas. And so the use of the product seems to be down some. We obviously have too much gas being produced at this time to help the commodity a great deal. Therefore, you need a winter. And I think that's where people are projecting some price increases to be. They're also hoping that shut-ins of oil will affect the overall supply of natural gas. And I just don't know what to think about that. I think as oil begins to reach a plateau, at least at the oil producers, I think they now can breathe a little easier and make money. I'm not sure they're going to be disciplined enough to not continue to produce their oil. So with that's going to come more associated gas. So I'm not as bullish. I am bullish on natural gas. I think it'll be higher than it is today in the 170-ish range. But I don't think we're going to see, personally, I don't think we're going to see this massive recovery that others think we will. I look at it way longer term as it being a commodity of choice. And that's why I want it to be a part of my portfolio. But the short-term recovery of both commodities, oil and gas, and I know we'll be talking about LNG later, it's this COVID has not been the reason for a lot of our companies' issues. I wouldn't blame any of the issues that it has caused on a company's health. Some blame it on it, some don't. But I would say it is affecting the demand for our product worldwide, and it both natural gas and oil is being affected by demand-wise. And I think we're just going to have to live through that, get that demand back up, and then that recovery will slowly happen. But short-term views for me are questionable.
Looking at the Haynesville specifically, what about opportunities there, or what do you see happening there in the future? Again, hard to predict the future.
Yeah, when we had Covey Park, we were even then and now, I think there continues to need to be consolidation there. There's some fine producers over there. Some of them have certain things they have to overcome, mainly debt. They're all in the right place as far as I'm concerned. One reason we went to that area when we built Covey Park was because it's location and how close it was in its proximity to the market. We thought that was very important when we put it together. So that's one advantage that the Haynesville has over any other gas asset in the country, is that it's just right there at the market or very close to. So you have an advantage for that. It's a resource that was misunderstood a few years ago, and with technology and longer laterals and better economics for gas transportation, makes it a prime place to be, whether you're oil or gas. So for economics anyway, and in today's time where more equity partners are demanding that you actually make money, not just grow, it puts them in a very good position to have success there. I think there will be more contraction than there is today. I think you'll see fewer operators, but the only way that's going to happen is if those operators solve their debt to equity issues, and they still have some of that they have to solve, and so that's going to happen over time. But the combination will occur and then create healthier companies over there. And the situation we're in now has slowed that down a little, but I do believe you're going to continue to see contraction over there.
What about the LNG market?
Again, being a commodity producer, oil or gas, I've always believed you should really understand all aspects of the marketing and the ability to actually sell your product, not only produce it. And so I've spent a little bit of time thinking about and seeing where and what LNG was going to do now as well as in the future. I by no means am an expert. There are plenty of people that move that around the country that know way more about me, but I am somewhat concerned about LNG at the moment. I would say that we were on our way around this country to build and get the export demand that the world was asking for. I do believe that this COVID experience has hurt that quite a bit. It's a demand-driven resource that the world wants, but demand is down so much because of this experience that it's going to take a while to recovery. One thing that, as I've done some analysis around LNG, if you understand much about it, even though it is traded as commodity over the counter, most of the contracts, especially the successful ones that they got ahead of, or most of the people that built these facilities to export LNG did it on a physical trade, but they got it to the Gulf Coast, and then countries around the world guaranteed that product would show up, and they paid big dollars, big differentials to make sure that, that product got there to provide them energy. Today, with such a low commodity price, no one paying, when gas over here was trading at $4, people were paying $20. That made a lot of sense to build out the infrastructure and get that product where it needs to be around the world. Today, people can actually buy, they can actually buy the product for $2 anywhere around the world. So you just can't make the math work when you're trying to compress it into a ship. No telling what the ship costs per day to get it moved. They can just buy it cheaper somewhere else. So it's going to take a little while for that demand to start up again. And so we're just going to have to live through that. And what's surprising about the LNG market today, we were already beginning to see weakness in it. And there were months where we built our infrastructure around 10 BCF of export capacity, and even 2 years ago, there were some months we were only exporting 5 BCF a day. And so we were beginning to see the weakness of the world economy and the demand for it. And I just think it's going to take a while to recover. So we as producers are going to have to take that into consideration, not just there's no place for it to go. So we just have to be more disciplined about our approach to producing it. Not worry so much about growth is making a profit. And with that, the demand will come back.
Interesting take there. Thank you for that. And John, you talked a little bit about Covey Park, and you also talked about, the need for the industry to consolidate to a sense, or, maybe get smaller. So can you talk a little bit about Covey Park, the acquisition there, and your thoughts about consolidation and things of that nature?
Covey Park was built on an acquisition model in a time where it began in the summer of 2013, in a time where leasing acreage, drilling a couple of wells, selling it to a growth company was the order of the day. We always had the approach and took the approach that we would acquire cash flow production with upside, try to be a better operator, enhance the ability to produce natural gas or oil if we had that in our portfolio, and figure out a way to actually not worry so much about growing and worry a lot more about how much money we could make with true positive cash flow. And ultimately, that's the way that worked. And of course, the process was through acquiring assets. We made 5 large assets as other people wanted to divest of those. So that got us where we needed to be in the acquisition phase and the building phase of our company. So I've always taken the approach that through aggregation, especially at that time, you can relate to the times we're in now, because we were buying gas when nobody else was. And so if you look just at the history of that versus what we're being faced with today, being able to accumulate those assets in a time, not only to get, some of my friends are not going to like this, but to get drilling rigs off the market, do the math, get this thing working correctly at a price you could afford, begin to make that money, the aggregation and the growth of the company happen that way. Not so dissimilar than what we're going to have to do today. The issue is not about this phenomenal business that we're in, and national security that our industry provides, and as much of the freedom as we talk about today, Constitution, but in what oil and gas producers do for this country and what it allows them to do there. But we just have too much of it. So currently, and so contracting, consolidating, making better companies out of these others, if you can, putting them in the hands of in some cases, better management teams, the commodity price will take care of itself. But when everybody's hustling around to produce and not paying attention to the demand and market we're in now, it causes gluts that we have today. So this consolidation will happen. It'll happen naturally, either through companies that need to restructure their balance sheets, and then there'll be others that just totally have to go away, have decent assets, but for some reason or another, due to the times, they can blame it on COVID if they want, but their financial structure is not going to allow them to survive. But those assets may be good enough and to end up in the hands of others and make it a better industry for the times.
And John, your final thoughts, if you will, on the rest of 2020, I guess, the path forward from here and moving into next year as well. What do you see overall?
I see tough times. I see, you know, a lot of ups and downs. I see hope in the commodity. I see that today. I see some, I think we'll see the yo-yo effect of that. It'll be up sometimes, and then we'll look at our monthly numbers and we'll go, oops, maybe we got a little bit zealous, and they'll go down a little bit. And I just think for now you're going to see some very interesting times, and it's hard to predict ultimately what we're going to do short term. I wouldn't be sitting here and thinking about starting another company if I weren't very excited about what our industry is going to be and what its future holds. I don't think there's anything that's going to take the place of oil or gas for some time to come, not in your future or in mine. So I think we need to stay focused. I think we need to be better stewards of our partners' money. And I think if we begin to think less about growth and more about making our partners money, then the commodity price will take care of itself, because you'll naturally decrease your volume to increase your net value per barrel or per MCF, and which ultimately should get you back on the right track to profitability. So I look forward to what it brings, the ups and downs associated with it. I'm not and don't care much for what we're going to have to go through emotionally with jobs at stake, because they are. I think we're going to have to make really tough decisions about that. I think people are going to have to do more, or have to do way more for less. I think we got a little bit fat and sassy, and it got a little bit easy. And I think from 2014, when oil got up to $1.07, by the mid 2016, it was at one time $26 at its low, and then we had the world was telling us we had a problem, and we didn't listen. We got somewhat of a recovery to $50 or $60, and we went, oh, there's hope here. And instead of helping or thinking about what we should do then, we kept right on filling the bucket with too much of a good thing. And so here we are, where we totally put ourselves in a situation where we need to recover and heal over time. And I think that'll happen.
We definitely appreciate your insight, your expertise, and also you letting us look forward to the future. We look forward to seeing you in Shreveport in October for our Doug Haynesville conference. But in the meantime, best of luck with everything, John. Thank you very much.
Thank you.
You're very welcome.
For more Hart Energy videos, follow our social media channels.